Good afternoon. It's September 21st, and this is To My Liberal Friends. Thinking of buying a house, but you want to wait until the mortgage rates drop? Well, you better think again because it does not look like they're going to be going down anytime soon. When Joe Biden took office, the average rate for a 30-year fixed-rate mortgage was at 2.7%. That was about as low as it could go. Today, that same mortgage will come in at close to 7%, and that means you're faced with a set of problems before you buy a house. Way back in 1980, my wife and I were trying to purchase our first single-family home. We had a townhouse in the suburbs of Washington, D.C., but we had an eye on a bigger house for our growing family. It was going to be a Ryan home, so a basic home for most buyers. We started out looking at the Shenandoah model, but interest rates were rising at a rapid rate, and that meant we would have to drop down and purchase the Ardmore model, about 25% smaller. When we finally closed on the house, we had a mortgage at 13%. Now, we could have bailed on purchasing the house, but I was convinced that Jimmy Carter would do something to reduce those astronomical rates in an election year. I was young then and did not realize what he had set in motion could not be undone solely by him. Well, buyers today are facing a similar problem. Inflation has had a double-barreled impact on potential home buyers. The first was the rising interest rate, and the second, inflation, has driven the cost of housing to record highs. The average sales price of a home under Biden's presidency has increased from $403,900 to $516,500, about a 25% increase. And looking at this strictly from a financial aspect, that means the annual cost of your mortgage is on average just over $15,000 more a year, and over the life of a 30-year mortgage, that house will cost the buyer an additional $460,000. Since wages have not kept up with inflation under Joe Biden, that means the cost of an average mortgage has increased from 30% of the average worker's wages to a staggering 52%. And all these numbers mean problems for Joe Biden's reelection campaign. And the Federal Reserve, well, they sent a clear signal today that interest rates will remain much higher than before for a significant period of time. They may make only one more increase of 25 basis points, 0.25%, but they don't see any reductions coming anytime soon. The era of cheap money seems to have come to an end. The mortgage rates are highly sensitive to changing economic conditions. Many lenders use the yields on a 10-year U.S. Treasury note as a general reference for rate changes. And the increases in inflation and the federal funds rate, that's the interest rate targeted by the Federal Reserve, at which commercial banks lend and borrow reserves from each other overnight, both generally contribute to higher mortgage rates overall. When the country experiences inflation beyond the Federal Reserve's current 2% average target, adjusting the federal funds rate is the Federal Reserve's primary reason and ability of slowing the pace of a price increase throughout the economy. By raising the federal funds rate, the Federal Open Market Committee is essentially making it more expensive for financial institutions to borrow money. This cost is then passed on to consumers in the form of higher retail interest rates, including those on a mortgage. The question on most potential home buyers' mind is who caused this problem? They know the culprit's high inflation, but what caused it? Well, inflation, as commonly measured by the Bureau of Labor Statistics Consumer Price Index, the CPI, hit 9.1% over the 12-month ending in June of 2022, the largest 12-month increase in more than 40 years and significantly higher than the 1.4% measured at the end of the Trump presidency. In a February 22 piece for National Review, Michael Strain, an economist for the American Enterprise Institute, estimated that about 3% of then 7.5% annual inflation rate could be attributed to Biden, and most of it attributed to his administration's American Rescue Plan, which appropriated $1.9 trillion in spending on measures including additional personal stimulus checks, extended unemployment insurance, and increases to the child tax credit, earned income tax credit, and child dependent care tax credit. It's important to note the considerable uncertainty around the estimate. End quote. Strain emphasized, I can produce estimates that are both higher and lower than 3 percentage points, but that magnitude is in the mid-range of reasonable estimates. Those are the structural factors that are important to consider. Strain still believes that the Biden administration's high spending was a significant contributor to inflation and in turn mortgage rates, and I agree with him. If we had, quoting Strain, he said, if we hadn't had excessive monetary and fiscal stimulus, I think we would still have had inflation that was considerably above the Fed's target, but I don't think it would have been nearly as expensive as we have now. Assigning precise rates shares of blame for rising mortgage rates, it's an impossible task, but the stimulus package that Biden signed into law was a sizable contributor. Mortgage rates would have almost certainly risen in the absence of the American Rescue Plan, but anyone looking to purchase a house today would not be entirely unjustified in pointing the finger at Biden when faced with the highest average borrowing cost in more than 20 years. And this is going to have an impact on Joe Biden's re-election efforts as he comes to grips with these realities. It's been To My Liberal Friends. Thanks for listening. If you enjoy the podcast, hit the subscribe button. And if you have a comment, go ahead and leave it.